This is the Mobile Home Park Lawyer Podcast with Ferd Neiman. If you're looking to generate wealth and passive income in the lucrative world of mobile home parks, you're in the right place. You'll discover solutions to the common legal and operational pitfalls and how to optimize parks to maximize income. Your host is in the trenches. He's a real estate attorney, financial analyst, and mobile home park investor and operator. Now, let's turn it over to Ferd Neiman.
Welcome back, Mobile Home Park Nation. Ferd Neiman here again today with another episode. Got a great guest for you today. He's a mobile home park owner, operator, also does self-storage, raises tons of money, got lots of experience. Really excited to have him today. One of the more well-known guys in the industry. Please help me welcome my guest, Ryan Smith. Ryan, thanks for coming on, man.
Thanks for having me.
Yeah, well, good to get you on the show finally. I know you've been on some other podcasts and heard you present at Seco, had a great presentation there and lots of other places. But for those of our audience that do not know you, maybe give us a little bit more about your background and then how you got into MHP and what you guys are doing today.
Yeah, so background, I've been in the mobile home park and or self-storage business for coming up on 20 years. How I got into the space, I'm an entrepreneur. I've never had a W-2, so it's kind of been one thing leading to the next. But in short, came from a real estate family, single family residential. Ended up, I was a coder, liked to write software, so I wrote a software program for my dad to help him do his analytics. I thought it would be a fun kind of practicum. And so I built this software application that my dad used for his business, turned it into a business that actually made quite a bit of money. And then took that money, parlayed it into single family residential with my wife, who's a business partner in our business. We bought about 30, I'd say, homes, single family homes in our early 20s, because it's what my family did. It's what her family did. We realized pretty quickly it wasn't scalable. And so we started looking at something that was more scalable, generated income, had capital appreciation. And then we were looking for something called cycle resiliency, non-correlation, or low beta, and landed on this concept of mobile home parks as a potential avenue. Bought one, it turned out okay. Bought two, turned out good, and 3, 4, 5, 6, 700 later, and here we are. So it's been a lot of fun.
Wow, that's great. Yeah, I think a lot of people in the industry came out of the home flipping business, or the single family rental business for the same reason, right? It's scale. And I did it. I started in single family. I had a day job that I did on the side, and I realized, once you got, I think the number was 10 at that time. Once you got to 10, you couldn't really get good loans. It's just like, what do you mean? Like, no, you need to have 30% down. You don't fit the box. Like, okay, well, in addition to how do I manage 100 rooftops? I thought, well, we'll go look at, maybe I can get 2 50-unit apartment complexes. That'd be easier to manage than 100 homes. Well, guess what? Other people figured that out. So there was a lot of efficiencies in apartments. So the cap rates were lower, right? The yield was compressed because of the competitiveness. Oh, crap. So similar thing, like, man, I'm making high yield in single family, but I can only own so many, and flipping homes is for the birds, I thought. So like, well, I got to get something that I can maintain, quote, passive income. Obviously, MHP is not that passive depending on the project, but got into the space same way, man. And been here since, right, and love it. So that's great. So what kind of stuff are you guys buying now? I know I see your stuff online, followed you guys for a long time. You're buying a combination of storage and MH. It seems like you're buying top tier assets and top tier markets. Is that kind of the plan and the business model at this point?
It is. I think, everybody has their path, and everybody's on a path, to an eventual end. But I think, starting with the end in mind, I think the goal of owning quality, well-located real estate and a good market, and then never selling, I think generally turns out fairly well. So we like quality markets. So we just closed on a storage facility a couple of months ago in Alexandria, Virginia, about a half mile to a mile from Amazon's HQ2, Pentagon, is right up the road, Reagan International. So really well located. So we also bought a mobile home park earlier in the summer, 209 space park in the DC Metro, which we like a lot, and just bought a storage facility last month in Houston, Texas. So to your point, we the number one question we ask on anything we buy is it moated? Is there a distinct barrier to entry? Is there something unique about that property that allows us to compete and protect our capital? So Generally speaking, well-located real estate it tends to be moated.
Yeah, and by moat, just for our other listeners, moating, you're talking about a moat like a barrier to entry or protection against competition, and you're kind of insulated from risk to some degree.
Correct.
So, and I know we've talked previous as well that your attitude is more risk-adjusted returns, risk, not necessarily afraid of risk, but an appreciation for risk and an aversion to undue risk. How does that compare to what you're seeing in the marketplace? I mean, what I'm seeing cap rates at prices I can't believe. I'm seeing people buy stuff that, I mean, I've been off by 50% on bids. I'm like, I'm not even going after stuff right now that's called for offers, because I'm like, it's not worth the energy to be disappointed by half. The greater fool has more money or less sense than I do. So what are you seeing, and how are you, avoiding those sort of problems if those are the problems you're seeing in the marketplace?
Yeah, so I guess as a general statement, I'm saying it seems to me that there's a lot of loose and fast going on, to a degree on both sides of the table. I see operators taking quite a bit of risk, knowingly or unknowingly, and I see capital, LPs, taking quite a bit of risk in what they demand of their operators, knowingly or unknowingly. And so typically the value chain, as I've seen it lately, is you have a base or a pool of LPs that have been LPs in this space, looking in this space for maybe the last 1 to 3 years. They have a presumption of the way it works or the way they would like it to work. And then you have newer operators that need to raise capital. And so in many cases, they capitulate to kind of the whims of the market. And I can be specific as to what I mean by this, but as a general statement, you have, I think, LPs taking quite a bit of risk in the way that they look to invest at times. And you have operators, many of which are newer, kind of acquiescing to those demands in order to raise the capital, in order to buy the deals. And so, as a general theme, the capital raising process is quite verbose, a lot of promises, lofty language, forward-looking projections to raise capital, things that, I would say we do not do. Pro models, we do not use those for marketing purposes. And then from a model standpoint, you're seeing, basically the promise of yield as kind of the marketing hook, so to speak. Cash flow, replace your income, quit your job, go from active to passive. And so what those operators generally do is they go downstream in quality to get yield. So more and more rural, heavier and heavier infill, more and more hair, set it up. And so, like I think we've talked about before, I don't have a dog in the fight, so I'm not predicting an outcome. I think if everything continues as it is in a linear basis, I think, or linear fashion, I think things will turn out quite fine. But if anything were to change or take a hard right turn, that model may not prove as fruitful. And who knows? I don't have a dog in the fight either way.
Yeah, I mean, I think there's definitely more risk in general I'd agree with you on parks that are rural or infill. I mean, one thing we've seen in the last year, we just bought a park in rural Kansas for the purposes of moving all the vacant homes to a park in Kansas City Metro, used homes, because we have a park here. And my allocation, I ended up getting an allocation for 2022 of 11 homes from True. And I'd bought dozens of homes from them in the last couple of years, and I can only get 11, and I got 0 in the last 8 months. So my ability to infill with new homes outside of my control is impacted. So that park in particular, the infill projections are off, right? Had the park been 99% occupied, it would have been, wouldn't have been an issue now. So there's definitely additional risk factors on deals that are just have more hair on them. And rural market, if you lose an employer, it hurts. So you can get the yield. Now that deal is that I've described, we had a yield expectation of 30% IRR, right? So you don't get that on a deal unless you buy it at a stupid low price, right? On a deal that's 99% occupied. So it's inherent with risk. And because we can still infill it, and we just got 10 homes we're going to move in there right now, used homes, it will be full here in the next 5-6 months, because I did get the allocation for some of the other ones. So I will be full in 6 months. So I'll be 6 months behind, but it's not that big a pain point on the total yield, because my valuation doubling, and it's still going, and in the meantime, cap rates have compressed. So I probably end up doing better because of those other macroeconomic factors outside of my control. But definitely with you there. And I see it happen to performers all the time. I see it on clients too. I'm like, guys, and one client in particular, they bought an infill park and they're like, we're going to put in 30 homes in the first 6 months, and then we're going to do a cash out refinance and at 80% LTV. And I said, which bank gave you that approval? They go, well, we haven't done it yet. We haven't gone to the banks yet. I said, well, I can't get that loan in six months at 80 LTV cash out with no seasoning if I pull off the 30 infill in 6 months. And I've got more experience, better banking relationships, and a better balance sheet than you do. And I'm 15 years older than you, which also helps to some degree. So guys, are you want me to do your paperwork? I'll do your paperwork. But you want me to give you some advice? You need to change your pro forma because this is not going to happen. And then in this instance, they appreciated it, right? But that's the kind of stuff I'm seeing. What are you? Not all the time, but so what are you doing in the marketplace when you see that? Are you, in some degree advising mentees or on your own portfolio? Or are you just buying slower, being more selective, waiting for others to fail, and then you can buy on them from the bank? So what's the 1, 2, 5 year vision on those?
Yeah, so I guess in taking it in part, and actually I guess three different things, and this may not be sequential to the question, but first, to your point on the 80% LTV, there's also the question of just because you can get it, should you? All right, what is optimal? So our model on that is 65%. We acquire at 50% loan to cost, because again, going back to what we kind of talked about at the top, if you have a incredibly well located asset in a really good market long term, again, and you hold it for time, theta, then things will turn out quite well over, will likely turn out well over time. The key is to not lose it. One of the number one reasons you lose a property is too much debt or the wrong type of debt. So when we acquire a property, we're generally 50% loan to cost at acquisition. We can certainly get much higher than that. We choose 50%. So I'm not, and then when we refinance and do cash out refis, we generally go to 65% from a margin of safety or risk standpoint. So I offer that just to say, just because you can get it, you may or may not should, doesn't make it, I guess, right. And then second, I guess to your question, I do advise people. There's 3 operators and actually several different asset classes that I do monthly calls with at scheduled times, and we talk through questions pertaining to operations, capital raising, work-life balance, faith. It's an amalgamation of a number of things. I really enjoy it. And then there's also the ad hoc. I have friends of mine that I don't do that with necessarily. They've never asked. I might be booking up my calendar after this one. But there's a friend of mine in particular. He has a fund that he last year brought to market, and I called him and said, "What are you doing?" I just called him out of the blue. I said, "Buddy, love you, but what are you doing? Knock it off." And gave him feedback, and he took it, which is good. And then I guess the third part was to your question on the, I think it was 2 to 5 year plan. But basically, I think the kind of the gist of the question is, how do we compete today that without necessarily being the highest priced offer? And maybe if that's not it, but I guess if that was the question, I think so. 2 of the last deals we bought, one in DC Metro, it's a mobile home park, 209 spaces, and then a 900 unit storage facility in Alexandria, Virginia. Both of those were not widely marketed. Those were limited distribution deals. We received them. We were included in the process due to reputation in those specific markets. In both of those deals, we won the deals, and we were not the highest price offer. I think one, we were lower than the highest by more than $1 million, and I think the other one was about $1 million lower, and we won. And so in one of the deals on the mobile home park in the DC Metro, another group was newer. There were 5 groups that saw the deal. We were one of the 5. I think we finished third in the in the bidding or the offer, and we won the deal because the seller knew the seller of another park we had bought about 10 miles up the road. And the other group that offered the most was less proven. And so they went with surety to close, and I'm assuming that this is the case, but I believe they went with the likelihood of closing, the unlikelihood of retrading the deal, which we generally don't retrade unless there's some gross material defect in the information that was provided. So anyway, we try to choose the deals that we don't necessarily have to win by being the highest price offer on and reputational carry. We certainly lose a lot of offers, as I'm sure you do too.
Right.
We make offers all the time, and we're okay with losing them. We just kind of pick our battles and move on. And then at the end of the day, we're national in scope. We're across 2 different asset classes, and we're trying to buy 2 to 4 deals a year. We're not trying to buy a deal a week. So it allows us to be kind of picky and choosy and patient.
Okay, that's definitely a good approach. So when you've got 50% leverage on the acquisition, that obviously has to impact your yield to make it less in the short run, at least, because you don't have the leverage. I mean, we all learn real estate finance 101. Leverage is part of what allows real estate to be superior yield to stock market, for example. So how do you balance that? I mean, obviously there's less risk with less debt. How do you balance that, and why, if 50 is good, why refinance at 65 instead of refinance at 50 also?
That's a good question. So I think in part, the first part of your question, I think one of the competitive advantages we've tried to build, I've been pretty proactive over the last 5-6 years, is I figured that kind of the path of cap compression would likely continue. I'm not saying I saw that where it is today, so I don't have that kind of crystal ball, but I thought it would likely, yield would be compressed, all things being considered and all things being equal. So, my approach was to, in short, create a base of capital that saw the world the way that I did, which is not necessarily deploying capital based on the highest promised return, short-term return. Because going back to kind of what I said earlier, the thing I don't like about that is, in order to accomplish that task, it's going to push me to take pretty significant risk in the model, where if anything changes economically, I could be holding a bag that I don't want to be holding. And so we've been pretty proactive in communicating with investors that yield is going down, and to expect it. And at the end of the day, as an operator who then creates opportunities to invest through our funds, it's saying, here's what we do, here's the risk we're taking, here's the team, track record, all of that. But at the end of the day, this is what we're offering, and it's a market. And if people want to take more risk or chase more yield, there's other options. But if somebody wants, maybe a more conservative approach, then they may consider us. And we have not struggled at all with our capital raise with that kind of approach. If anything, it's accelerated a little bit. So that I would just say we picked the path we wanted to go down, and thankfully other people came with us. Probably get a shorter summation. And then on the second part of the question, I forget that. Sorry, can you remind me what that was?
Well, I think just long-term view and how it impacts. Well, in this case, how do you temper your yield, and how do you how's that working from a business plan perspective? Because it's like, if I was curious, if it's 50% leverage at the beginning, why is 65 okay later? You'd almost think it'd be the opposite, 65 50 or 65 65, because most time banks will give you 80% on the acquisition and less 65 for example on the refinance. Obviously, the 50 on the acquisition is going to make it easier to get approved for acquisition loans. But if presumably the value goes up over time, so if you also increase the leverage percentage, you're really going to add a ton of debt at the refinance timeline.
Yeah, it's kind of what I would say. 65% is somewhat arbitrary. Why not 66? Why not 64? But to your point, 70-75%, depending on where we are in the economic cycle and what the environment is like, is probably the theoretical maximum that you can cash out in those cases. Maybe you can go to 80 in some cases, but then there's back to the case of should you. So and this is a very rough kind of metric, but generally speaking, your break-even occupancy is 5 to 10 points higher than your leverage rate. So, and this varies. So if you're 50% at acquisition, 50% on the cost at acquisition, you need, call it 60% occupancy to break even. It's an economic occupancy to break even. So you have a very large margin of safety, right? We look at, you look at the Great Recession and occupancy and storage, for example, was about 88% nationally. So if I need 60 and 80, I've got a wide margin of safety, which I want. And then as you operate the asset to a degree, it's not, you're not taking away all risk, but certainly 5 years in the future, especially if you're doing forced depreciation and doing CapEx, you've likely de-risked the asset to some degree. So in our belief, it's okay to maybe go a little bit higher, because if anything material with the model, it would likely avail itself in the first 5 years. So we're okay with maybe going a little bit higher leverage, 60, 65 at year 5, which then, using that same metric, would take break-even occupancy to 70, 75%, which is still a pretty significant margin of safety set against the historical averages. So now if you get in the 80% range, now you're 85, maybe upper 80s, and now you're bumping up against, I'll say historicity and the potential of maybe having lost that asset at certain times historically. So, and we don't want that.
Okay, that makes sense. Thanks for the analysis there. Thinking about the cap rate trends, you've seen them compress the last several years. What do you predict? And then where do you think we're at in the overall market cycle for this asset class? I mean, consolidation is clearly happening to some degree. How many more years do you think it is before, you can go out and buy a single 50-unit space in a decent town with decent condition? We're going to have that forever, or are those going to all be taken? Right now, the 400 parks and the 200 parks are already getting gobbled up pretty quickly. 100 is already in process. Are we going to get to 52 and then maybe even lower? What's your view on where we're at and where we're going?
No, I don't think so. Because the presumption to a degree, the presumption is that all the current models will continue to work in perpetuity as they are now. And I think that's unlikely to be the case. So I think there will be models that shake out possibly and are disrupted, which then create new opportunity and reset things. But certainly, I think mobile home parks and storage, both asset classes will continue to consolidate, and they are, and they have been, and I think will continue. But I think there's a lot of opportunity, and will continue to be opportunity for at least the next decade and beyond. As far as cap rates, I don't know obviously what's going to happen with them, but to a degree, I don't have necessarily a dog in the fight because it's kind of Newtonian in a sense. You have more of something worth less, or less of something worth more. In that if inflation does in fact stay where it is or elevate on a sustained basis, and if I have what I would define as a fundamentally good business, which is a business you can pass inflation on to the customer. If you can't pass inflation on, you've got a bad business. Whether you know it or not, that would be a bad business. So if I can pass it on to the customer, then my NOI will take off probably, significantly more than I projected it to, which, case in point, 2021, our revenue growth was unbelievable this year. So the point is, you can argue, well, if inflation rises and interest rates rise, cap rates might rise, but if I can pass it on to the customer, so will my NOI. So I have more of something, maybe valued at a lower multiple, i.e. a higher cap rate. But the net effect to value shouldn't be overly significant. The interesting thing, and I was interested about a year and a half ago when Powell made the comment that I think they were going to consider inflation in the aggregate. That was an interesting comment to me because historically, there's this statement in real estate, and everybody's probably heard it 100 times over, where real estate's like a ship in the harbor. When inflation comes in, the ship rises. You can pass it on to the customer. But unlike the ship in the harbor, the interesting thing is if inflation comes and you pass it on to the customer, when inflation moderates, rail rates don't typically go back down.
Right.
So now the ship is staying suspended in air. The water goes out and the ship doesn't move. But the interesting thing is historically, when inflation comes like in the late 70s, and my business partner, Brian, was active in that time and loved that time in real estate. It was one of his favorite times of the last, 40, 50 years. He's been in business 52 years. One of his favorite times was in the late 70s because of inflation. Because in his comment was, we passed on to the customer, revenue grew, net operating income grew. And then when it moderated, customers continued to pay that rate that was fueled by inflation. But then obviously as inflation moderates, interest rates come down, cap rates tend to compress, and now you monetize, now you have an elevated NOI and an elevated cap rate. It's multiplicative. So anyway, it's complicated. So
that's a good positive spin on inflation. It's just ride it out, wait, and then you're going to get the benefit when inflation decreases.
Yeah, there's a point. It's like, everything in moderation, including moderation. I think Trisha Yearwood said years ago, which I love that comment. But there's a point where inflation could be bad for the consumer, and obviously we're all worried about that. But inflation in moderate amounts I don't think a bad thing at all. I think it can be quite useful.
Interesting. No, I've never heard it put quite that way. That's interesting approach to inflation. Generally, it's just like inflation bad,
Yeah. Well, it is. It might be. If you can't pass it on, then it is bad. And that's where kind of going back to tie it back to something I think we've talked about on this discussion is when I reference the risk people are taking, to me, and this is my presumption, and I might be wrong, but my presumption is that not all mobile home parks might be able to pass inflation on the same. Not all locations, not all quality. So to me, if inflation is something that is here and growing, I think quality, well located, higher quality parks will be able to pass it on far easier than the other end of the spectrum to the extreme. So I don't think inflation's a bad thing for our model, but it may be challenging for others.
Yeah, that makes sense. I mean, in the heavier lift projects that are more risk on infill, also if inflation goes up, your consumers, your buyers have less purchasing power. You can't just push the rents on vacant lots. You got to keep your rates reasonable and or lower in order to get the occupancy. So no, I definitely can see that. That's good stuff. What are tips, Ryan? Anything else before we go? Any tips or tricks you want to share? Or if not, you can tell us where you can find you, but don't want to take all your time, but this is good stuff. And definitely don't want to cut you off if you got anything else you want to share.
Yeah, I mean, I think we've kind of talked or kind of hinted around it. I think I think the biggest thing is for investors and operators to understand the value of a dollar. And there's a cap rate component to that discussion. But there's, I'll start by saying, I guess, really quickly, it's very hard. And I think a lot of your investors who are looking for passive income, they probably already know this quite well, but it's nearly impossible to earn yourself wealthy through cash flow. Right. That's the problem most Americans have is, work hard, get a job, save your money, and then 30 years later, where's the beef? And there's no beef, because the entire tax regime is really set against you being successful, trying to earn yourself wealthy through income. So the focus, in our opinion, is to create wealth, whatever society thinks of wealth. Society may love it or hate it, but I can then choose to do with my wealth things that then benefit my community and anyway. But the point being is, from wealth, you can create all the income you need, but it's very, very difficult to earn yourself wealthy. And so understanding the value of a dollar is incredibly important. So comparatively, a dollar of earned wages is, call it 50 cents saved or whatever your allocation is. But in our business, a dollar of NOI every month. So I'm in the business of finding dollars. It's what I consider my job is I find dollars. So if I find $1 a month of net operating income in a property, that's a 5 cap asset. Whether it's higher or lower, let's say 5 cap asset. $1 a month is 12 a year, divided by 0.05 is $240. So I'm in the business of finding $240. Most Americans work for 50-cent dollars, right? So it's a world apart, Now, this is kind of where there's, I guess, 2 quick points is if I was in a 10 cap business trying to find 10 cap or better, which you see often in the industry, we're buying 10 caps. It's like, right. In my opinion, that's, that might not be a positive thing based on what I'm saying here. A 10 cap, a sustained 10 cap asset, $1 a month, 12 a year divided by 0.1 is $120. So that person's in the business of finding $120. I'm in the business of finding $240. My dollar is worth twice as much as that dollar. And so on a net basis, I think I might be in some cases taking the same or less risk than they are to make quite a bit more on a risk adjusted basis coming ahead. Now, lastly, for the person on the podcast who's more analytical and like kind of schemas and schematics, you can take just really roughly what I laid out and work backwards. So let's say your goal is to create roughly ballpark. Let's say your goal is to create $10 million in net worth for yourself, more than what you have now. So at a 5 cap, assuming you're buying 5 cap, sustained 5 cap real estate, you need 500,000 of NOI, annual NOI, to have a $10 million more NOI than we have now, which seems like an insurmountable, crazy goal. Can't do it, impossible. So if you break it down into bite-sized chunks, taken into monthly increments, so that's 40,000 approximately a month of NOI, 500,000 divided by 12, I'm rounding 40,000 a month. So you need $40,000 a month of NOI to have at a 5 cap a $10 million net worth, which is still a lot. Can't do it, all of that. So if you say, okay, well, if you have a goal of 1,000 units, take the 40,000 a month of NOI divided by 1,000 units. That's $40 a month across 1,000 units. So if you have 1,000 units and find a way to increase your NOI $40 a month each unit, you create $10 million of net worth for yourself at a 5 cap, which still is okay. That's a lot, $40 every unit. So give yourself 5 years to do it. So take the $40 divided by 5, that's $8. So if you bought 1,000 units, added $8 of NOI every single month for 5 years straight, you have $10 million net worth more than you have today. And so when I buy a property, I'm looking for $240 because I know the net outcome of what that'll produce. And the activity may seem trivial and insignificant and neurotic, but those dollars matter. And if you know where value is created, that's where your focus goes. And then that influences and informs your activity along that line. So hopefully that, I really hope that makes sense. And I hate to.
No, I think you've articulated that well. I've heard you give that explanation before. It's kind of a contrarian view where, but maybe not, but I mean, contrarian in the sense that we're supposed to chase 10 cap, not 5 caps. Like yes, you want a higher cap rate if all else is equal, but all else is, you're saying is not all equal. You get the 10 cap in, rural Missouri, you get the 5 cap in Washington, DC. They're not equal, right? If you could buy the same, obviously when you try to buy a 5 cap, you'd like to buy it at a 6, but it really be a 5, right? So, I mean, I got a park it's a 5, but I paid a 7.5. So I'm like, okay, now I came in with upside, and then that $8 analysis, it's just going to yield more fruit. So I'm with you on that. And I'm with you on, just in general, building wealth is takes more than just a paycheck, right? It's you got to have a massive paycheck, like a professional athlete or something, in order to build wealth through your job, right? So I mean, that's how kind of why I started pursuing rougher deals, because I'm like, I can't quadruple the value of a 5 cap asset in 2 to 3 years, but if I buy a 15 cap, it's possible for me to also 15 cap it, and then if it's also 40% occupied, I can quadruple the value in 2 or 3 years, and then I can refinance, and then I have a big chunk of cash, and then I can take that cash and invest in stuff that allows me to live the lifestyle I want to live. So I think however you get there, it's the tax man taketh, and how do you nothing better than real estate combined with cost segregation, combined with accelerated depreciation, combined with being a real estate professional to avoid paying income taxes in a legal and strategic manner, And that is the key to wealth. As I tell people, it's not how much you make, it's how much you keep, and you keep it by living below your means and by not paying the tax man a penny more than he's entitled to.
Yeah, agreed. I mean, the only way you pay tax on wealth is currently is if you buy or if you sell. That's really what it comes down to. One of those I'd say you control, and that's not sell, and that's our model. And then second, I think almost to your point, the challenge, I think, to your point of kind of value, cash flow versus capital appreciation. What I see is a lot of people leaving the corporate world where their world is cash flow, because that's the check every Friday. So they take a model, a mental construct that hasn't worked for them over here, and they jump to a lily pad and demand the same from that new lily pad, right? They haven't changed their view. They want a different outcome. They haven't shifted their view. I'm not saying that cash flow is a bad thing. It certainly isn't. But if you had to pick wealth or cash flow, if you had to pick one, I would pick wealth. Now we don't have to pick one or the other in real estate. Now, in the difference between 10 cap and 5 cap, it's how much of this and how much of that. It's a debate between amounts, but anyway, you've done great. I've really enjoyed watching you build your business, and I think the business you built is fantastic, and I think the content you put out is fantastic. So I commend you.
I appreciate it, Ryan. Appreciate you coming on here. This has been fun. Where can people reach out to you, or how can they find you?
Yeah, I'm pretty easy to get a hold of. My number is 407-602-7662, and that's my direct line here. And then our website is elevationfund.com.
All right. Thanks again, Ryan.
You bet. Thanks for the time.
Yep.
You've been listening to the Mobile Home Park Lawyer Podcast with Ferd Neiman. Ready to learn more? Go to www.themobilehomelawyer.com for free resources and materials to help you succeed. If you love the podcast, go to Apple Podcasts, give us your review, and subscribe today. Thank you for listening. Neither the Supreme Court of Missouri nor the Missouri Bar reviews nor approves certifying organizations or specialist designations. The choice of a lawyer is an important decision and should not be based solely upon advertisements.